Say what up to Guno. Guno's a 30-year-old civil servant stamping papers at the guchang, thinking about how he would love to put his money into the market. Some of the homies dropped their savings into a spec joint back in March and saw it double since then. He starts doing some research and comes across this. And then this. And finally this. Now he's not that sure. He knows that time in the market beats timing the market. He knows that diamond hands means holding tight to his assets and never selling. After all, you don't lose money if you never sell. But what should he do? Wait for the non-guaranteed market crash? Throw his money in now and hope he rakes in dineros going forward? Well, I'ma help him out. You're watching Secular, and today we're talking about the danger zone. Quick time, I just want to request that you please like this video and subscribe to the channel, and I'll try to keep the content coming in bunches and on the regular. Also, this is just a reminder that this is not intended to replace personal financial advice, legal advice, or really any professional financial service. We're not going to give you stock picks or tell you where to put your money. All we can really do is set the table and tell you what's on it. We'll do some research, but you should always do your own before making a move. Now let's get to it. So what exactly is the danger zone? Well, it's just the name I'm giving the stock market bubble that's currently getting more play than a Euro shooter on the Dallas Mavericks. What exactly is an economic bubble? That's a bit more difficult to explain, but whatever you're guessing right now is actually probably in the ballpark. In short, an economic bubble refers to a situation in which asset prices across a market are unsustainably or irrationally high when considering their intrinsic value. These circumstances are often driven by speculation, or the belief that the future of the assets in question will perform up to or beyond the purchase price. Basically, bubbles form when prices get unjustifiably high. They grow when, instead of rejecting the price and therefore forcing the market to adjust, the speculators continue to compete for the asset, shooting its price through the roof to an irrational level. Let's do a thingy. So let's imagine there's a city in the middle of Canada that has no shoes. Everybody in the town wants shoes, but for whatever reason, them joints have been confiscated and discarded. A shoemaker comes to town and goes to work. He sees the demand is high since everyone wants and needs a pair, and he's the only one who can provide them. Man knows they're only worth 20 bones, but due to the high demand, he charges 150 a pop. Even though we know that it's irrationally high, it's actually not that bad of a price for buyers in that situation, since the shoes are a scarce commodity in the town and can generally improve the quality of their lives. As time goes on, the shoemaker makes more and more shoes, and the price steadily rises as people try to jump the line for a pair. Low supply and high demand leads to a boom. Eventually, those ratty clogs end up selling at an even higher premium than where they started. In the meantime, much of the town's resources shift towards developing materials for the shoemaker, who continues to expand his operation. A secondary market develops in which people who already have shoes just buy up a bunch on credit, thinking that they'll be able to resell them and cash in as the price trend continues to boom. The first woman who does it cashes in nice. The next one too. By the end of the year, there's a shoemaker and 10 shoe sellers in town with large stocks of shoes in the back. A couple of them realize that their supply has far surpassed the demand, and people probably won't continue to pay the exorbitant prices for a commodity that's lost most of its premium value. In other words, everyone already has shoes, and the sellers see that they're no longer scarce. The prices are unjustifiable, so they decide to sell off their stores, take their profits, close up shop, and go live lavish. This is right at the popping point of the bubble, as we'll see soon. The first profit takers make a nice buck. But eventually consumers realize that they can't afford to or otherwise don't need to stock up on shoes anymore, so they stop buying shoes altogether. Shortly after, shoe sellers realize that they have stock that nobody wants to pay for and debt that they have to pay off with a dwindling primary income stream. Panic starts to set in, and purchases from the factory stop. With a decreasing demand from the sellers, the shoemaker's operating costs force him to shut down the bulk of his operations. This in turn puts a lot of the townsfolk out of work. The layoffs ripple from the factory workers to the resource farmers. Now, the people are out of work with no money to spend, the shopkeepers have dead stock and unpayable debt, and the factories are all shut down. The bubble has burst in the worst way, and the economy of this unrealistically isolated town has effectively crashed. So what was the point of this whole thing anyway? Well, If you search the term stock market bubble or housing bubble or debt bubble and add the word Korea next to it, you're likely to find at least a dozen doom and gloom articles talking about how precarious the economic situation of our country looks at the moment. I've already done a video on the housing market, so if you want to check that out, click the link in the top right corner. But for beginner investors looking to get into the market right now or wondering what to do with their investments in light of all the negativity surrounding the supposed bubble, we're going to get into this. See, one of the biggest problems with bubbles in general is identifying when you're in one. For that reason, there exist a number of quantitative measures that loosely aim to track how speculative a market is. That is to say, they aim to answer the question, to what extent are people under or overspending on market assets at a given time? One of the most basic metrics that aim to do this is the market average PE ratio. It's a simple way of seeing how speculative a market is, since the more speculative a market is, the more risk is involved. In short, it just means that the higher the PE ratio across the entire market is, the more risky the market. You can expand on it by looking at standard deviation and where we are when considering historical precedent, but the fundamental purpose of doing so remains the same. If one puts heavy stock into the established boom-bust cycle theory of economics, the higher the speculative peaks, the higher the falls. This theory also holds historical precedent, with the Great Depression and the dot-com bubble of the new millennium serving as the most storied examples. Simply looking at the progress of the KOSPI over a 20-year period exemplifies the ways in which large jumps in the market PE ratios have been met with sudden and steep drop-offs. This data, available from the KRX website and updated daily, shows the market to be at record levels of speculation not seen in the past 18 years. Now, this may not inherently mean that we're in a bubble or that the current situation is unstable. What it does mean is that the market is extremely speculative when compared to historical precedent, and therefore holds inherently more risk than usual. A better PE metric that you may want to look into if you're really trying to get into this is the CAPE ratio. That's a PE ratio that adjusts for 10 years of returns, but I'm assuming that most beginner investors are more interested in a general notion of where the market is rather than the specifics of those notions, so there's nothing too wrong with sticking to the most general measurements as long as you understand that they are, in fact, general. Another metric that exists and attempts to identify and value a bubble is that of the Buffett indicator. The Buffett indicator is even more basic in its conception and compares exactly what we're talking about when attempting to identify value. The total value of corporate equities, or the amount of money in the market, and the host country's GDP, or the country's real output. Many people, including Warren Buffett himself, like this metric for its simplicity and ability to identify whether markets are over or undervaluated at a given time using current and accurate data. It doesn't attempt to predict the future or judge the past, but rather it identifies where things are at this moment in time. Using this particular method, a value of 100 would suggest that the market is fairly priced, with any value below 80 representing a significant undervalued market, and any value over 100 being overvalued. At the end of last month, Korea's total market cap sat at around 113% GDP, and that suggests that the market is definitely overvalued. When looking at this information and combining it with what we know about the current average PE ratio, it may look to some like we're at the top of a booming period and primed for a nice little big-ass recession. In fact, when combining it with other economic insecurities like the national household debt to GDP, the housing market bubble, the unemployment rate, and the ridiculous amount of money that has been spent on stimulus during the coronavirus, I really wouldn't judge you for pulling your money out of banks and burying it in a remote part of the nearest mountain to your crib. But based on historical precedent, that also may not be in your best interest. Some have suggested putting your money in crypto, which is absolutely fine if you know what you're doing. Others suggest buying precious metals like gold or silver. Others still would tell you to act as if nothing will happen because stonks only go up. I'm not here to take sides on that though. If you've watched our other videos, you know that from bottom to top, the most important thing you can do before doing anything with your money is research. In the grand scheme of things, a good investment is still a good investment. If you think we're due for a rough economic environment, weigh your options with that in mind and use existing research and historical precedent to justify your decision. Investing Bengmanon that you got as a bonus? What do you think sounds like a better decision? A microcap biomed startup trading at 40 times earnings and a financial history shorter than your ex-boyfriend's dick? or an industry giant like Samsung Electronics trading below 20 times. Look, there's no way to know which will make more money in the long run, but the safer investment is pretty clear. If the problem that you see is over-speculation, then avoid over-speculation. Personally, I think it's always smart to keep the wisdom of the world's greatest investors in mind. In this case, let's turn to Warren Buffett. He once said, "I never attempt to make money on the stock market. I buy on the assumption that they could close the market the next day and not reopen it for 5 years." That is to say, remember that when you're investing, your goal should be to buy a company for the long term. The knowledge that the market moves the way that it moves, the discipline to build your portfolio as it does, and the temperament to stick with your plan knowing that you've prepared for it when things get tough are what tend to help savvy investors maintain their composure in the face of a market crash. Back to Buffett for 2 more quotes that are much clearer and more succinct than whatever I just said. 1. Buy into a company because you want to own it, not because you want the stock to go up. And 2. Risk comes from not knowing what you're doing. The way a market moves in the next 3 years should not matter if you're buying companies you intend to hold for 5, 10, 20 years even. Whatever you do it consciously. Use research, use numbers, use your brain, and diamond hands your way to financial freedom. If you're picking stocks, you're gonna take some bad beats along the way. Know that. But let's normalize taking L's as learning experiences. Alright family, this was a long one. If you found it helpful or have anything to say on this topic, hit us up in the comment section below. Also, I'd appreciate it if you could share our content with your friends whether they like it or not. Otherwise, take a little time out of your day and check out what's going on over at Hanggang Magazine. Donate to We Hope because they're doing a lot of really good work in Ulsan and Busan. And if you do live in Ulsan, check out This Korean Life to get to know the movers and shakers in your area. All the best, take it easy.